Hey guys, welcome back to the live stream broadcast. I look forward to these every week, so I'm glad you're here. I'm glad I'm here. And wow, today we got a lot of news to go through today. So I'm going to go ahead and maybe hit some of the earnings news. Then we'll come back and hit some of this really riveting stuff about performance measurement for our portfolios. And then we'll just have some time where we just kind of chat and talk about things. So, with that, let's get started. I'm going to share with you there we go. We have a 2023 earnings review and 2024 perspective from Whirlpool. So, Whirlpool's in my portfolio. It's one of my I guess my least proud investments ever, but it's there, right? And so I'm holding on to it, hoping for better times in the future. So the question is, what did they report out? So let's take a look. I'm gonna just show you this live. I have actually gone through this, but and then there's our the people who will be on the call tomorrow. But here's the results. They had 5.1 billion in sales, and that is a 3.4% year over year change. However, organic, which means non acquisition volume, was down 0.3%. That's not terrible though. Margin expansion, they've got a year over year and increased margins by 1.7 points. That's good. They got 366 million in free cash flow for Whirlpool at this point. That's pretty decent. Let's see what else we got. I did see some news that they were. I'll never find it now, but it says that they beat earnings pretty good. I mean, maybe we'll look for that here in a minute. I'll tell you what, let's go into Seeking Alpha and pick up WHR and Seeking Alpha, and it should tell us when we look down here. Yeah, here we go. Whirlpool non-GAAP EPS of 385 beats by 32 cents. That's actually a pretty good beat. And then the revenue beat by 110 million. So overall, things are not too bad from a 2023 perspective. I think the real challenge is going to be 2024. So I'm going to pass all of this stuff and just get to what we care about, which is 2024 guidance. They're saying that they're going to have, mid-single digits profit or sales growth, which is not uncommon from what we're seeing in other companies. They're saying they're going to expand their margins by 11 to 12% or to 11 to 12%. I'm not really sure ongoing earnings before. Oh, this is the EBIT percentages here. These are, I still don't understand. Why is this 11 to 12 and this is 6.8? Oh, this is the long term. I get it. These are the long-term goals. And so this is interesting then. So the long-term goals, maybe I should have read this before I got on here, but the long-term goals, they want to go in the mid-single digit range for sales growth. However, they're projecting 2024 to be flat. They're projecting, or their long-term goals are 11 to 12% in margins. They are expecting 6.8% margins in 2024. They're expecting 7 to 8% free cash flow, and they're going to be sitting at around 3.5. But 550 to 650 million in this market is not terrible for Whirlpool. But when we see flat earnings, margin, or sales and margin being flat, I don't know that that's going to land very well. They have a full year EPS of $13 to $15. Let's see what this stuff here just gets you from the 6.1 where they ended up to the 6.8 where they're projecting to be. And they're going to continue taking costs out. That's good. And we don't care about the segments at this point. So demand is going to be down in the first half of the year, up in the second half of the year. That seems to be a pretty common theme. The price mix is going to be down in the first half and kind of flat in the second half. Net cost, I wonder if that's net cost reductions are going to hit in both the first half and the last half. Cash flow guidance, you can see that they had $366 million in 2023. They're projecting 550 to 650. So this is a much better place for them to be. It's obviously not ideal, but it is. They've got positive cash flow, and let's see what else are they going to do here. They are going. Oh, here we go. We got clear capital allocation principles or priorities, and remember, one of the keys of the 5 pillars is capital allocation. So let's see what they say here. First of all, we can expect dividends of around 400 million. And yeah, this asterisk says subject to board approval, which makes sense. I had to look up what the dividends were overall, but then they expect 500 million in debt reduction. So that's a good use of capital in my perspective. And then they're going to have limited share buyback to offset share dilution. Not really sure what the share dilution is. I'll have to look that up, but they're going to do a few shares buyback. Doesn't sound like they're going to go crazy in the share buyback range, although it'd be great if they could. But a lot of times what we really want our companies to do is we want our companies to buy back their shares when their shares are low, right? Because that's a good use of cash, and we want them to not buy them back when they are really high. But a lot of times the cash that the company has to invest doesn't line up with that methodology. If the company is not doing well, like Whirlpool, they're not going to have the cash to just sink in and buy a bunch of shares. So they're doing the right things. They are constricted. They're limited in what they can do. My guess would be, let's go look at after hours. My guess would be that they are down in after hours. And that is the case. They're about $5 or 4% down. So that's not great, but it is what it is. So the other company that I have that reported here just after hours, so it's like fresh off the press here, is Graco, ticker symbol GGG, and you can see here that their sales actually did pretty well. Let's see what if there's anything in Seeking Alpha about them in terms of how analysts saw them. So we're going to go down here. So Graco non-GAAP EPS of 80 cents beats by 1 penny, and the revenue beat by 4.75 million. Obviously, Graco is not a huge company. Where was I? There we go. So it was a pretty decent beat. So let's we don't need to look at all this then. We can go down. Let's take a look at their 2024. I'll take a look at all this stuff later. And my process is I like to see certain things. I want to see how they did in the quarter. I want to see where they're projecting to be. And then any kind of news like that, like the capital allocation, any share buybacks, that kind of thing, then I will usually wait until the call to actually go through the materials. And then I take notes on the side as they're going through the materials with me. And that just kind of helps it stick with me. I don't know. That's just the way I do it. That's the full year of 23. So, we've already heard about that. Cash flow, liquidity. I want to see 2024. Where are you guys putting that? I think they're hiding that from us. Maybe I passed it. They should have something for 2024. Other discussion, cash. 2024 outlook. So I guess this is going to be it. So looks like they are projecting pretty flat and even down in the Asia Pacific range. And they're looking for sales to be about low single digit here for Graco. And, but I don't see anything else like earnings. Where's maybe I'm missing that. Yeah, I don't see it at all. So I guess we have to wait for tomorrow when they have their earnings call to find out what the 2024. Well, I'm not going to look for this anymore. I'm thinking I got to be missing it. It should be here because that's a big question for investors. Is at your last quarter of the year, what are you going to do next year? I mean, that's kind of a no brainer thing to put in your slides. But I just don't see anything. Yeah, this is going to be it. My last pass. Yeah, nothing. So there you go. That's GGG Graco. Sounds like it went pretty well for the quarter. Now let's see what, and they are up about 1% in after hours. So, that's, I consider that kind of break even. So I guess it's as expected. And, we've got Graco at a pretty good price. I think I bought them down in the low 70s. So that's, I'll take that. That's not too bad in this environment, especially in the business that they're in. So now what do? We got 17 people on. So let's go ahead and get our education underway. I'm going to take me off the screen because I can, and I'm going to stop sharing this one, and I'm going to share the other one, which is this one. All right, there we go. We're going to talk about benchmarking our investment performance. Maybe I will put me back in right there because I just want to be there. I want to be with you guys, right? So benchmarking investment performance. There's a couple of things that we're going to talk about. One is time-weighted returns, and one is money-weighted returns. And you're probably asking yourself, why do I care about this? Hopefully, this discussion will help you understand why we care about that. It's not that we need to spend a ton of time on it at any given point in time, but to understand them is an important thing. So let's get going. So our first thing that we're going to talk about is measuring performance. So when we measure our portfolio performance, it could be as simple as, and when I say that, I really want to emphasize that we need to be measuring our portfolio performance. Why is that? Because our portfolio performance is about, it helps us understand whether we are meeting our goals and objectives. So if we don't have some benchmark, if we don't have some goal out there, then we really, maybe we need to think more about our portfolio and what we're trying to accomplish with it. So I'm really going with the assumption that everybody agrees that we need to measure our investment performance. But it can be as simple as comparing the portfolio's total return with a goal. And that's kind of what I do. One of the things that I do is I say, you know what, every year I want to be 8 to 10%. Let's just say 8%. I want to be at least 8% return every year. It never turns out to be 8%. A lot of the times it's either lower than that or a lot higher than that. But on average, I want to target for 8%. It could also be comparing our returns to indexes like the S&P 500. So we might say, what did my portfolio do compared to the S&P 500 index? That's where money weighted versus time weighted matters. And we're going to talk about that here in a second. Comparing our portfolio returns to ETFs with similar goals. That's also something that I do because I'm looking at, I'm in retirement, so I've got part of my portfolio kind of focused on income, part of it focused on growth, dividend growth. So I'm looking for ways that I can kind of compare that to a benchmark. And I've picked a few of those, and you'll see those here in a few minutes. So it can be as simple as doing those three things. It can be even more complicated. You can add risk into the equation, right? So there's three ratios here that I want to just chat briefly about. Not that we're going to talk about how to do them, but you need to know that they exist. One is the Treynor ratio. It basically takes your portfolio return minus what would be considered a risk-free rate, like the Treasury yields or whatever, divided by beta. Now, beta, as you probably know, is and we talked about it a few weeks ago, is the volatility of the market. So it tries to factor out the volatility of the market or I guess it tells you what your return is per measure of volatility. So anyway, if you consider, I guess I should turn my ringer off. If you want to consider risk being volatility, this is a measure that you want to look at. There's also a Sharpe ratio. The Sharpe ratio looks to do the very same thing, except instead of beta, it uses a standard deviation. So how volatile is the market? How volatile is my portfolio? And so you actually do a Sharpe ratio on the market. You do a Sharpe ratio on the on your portfolio, and then you compare those. So that's the second one. The third one is Jensen's Alpha. So you've heard of that Alpha. Alpha is like Seeking Alpha, the website that we just looked at. That alpha is, what do we generate in returns that would be higher than what the market would actually give us. So that's called alpha. That's the kind of going above and beyond the market. So everybody's looking for alpha. So this is a way to kind of measure that. If you want more on those, you can just search those online. There are some dangerous measures, though, and I've seen them. I don't usually say much when I see them, but I wanted to pass these along. And if you're using these, maybe we can chat sometime about why. There's some dangerous measures that I see used a lot, and that is portfolio yield. A lot of times people will say, "Oh, I'm getting, 8% yield, or I'm getting 10% yield, 11% yield out of my portfolio." And the danger there, and it's not a terrible thing, but it is dangerous, and we need to understand the danger. The danger is that we are focusing only on the yield, not on total return. So if we end up in some yield traps, then we can end up actually worse off in the long run than we would have been otherwise. So focusing just on portfolio yield is not a great measure. And then also focusing on dividends received during a period or per period. I've seen people who want to get a certain amount of dividends in each quarter, and I guess where my head's at on that is that's kind of a dangerous measure, because at the end of the day, you want the best investment you can have, regardless of when that investment pays their dividend. So just be cognizant of that, and we'll move on. Measuring portfolio return, we have money-weighted returns. Now, I know your eyes are going to glaze over here, but I do have an example at the bottom, and I think it's going to be really clear why this matters. So money-weighted returns, the performance of an investment incorporating the size and timing of your cash flows. So it's basically your portfolio return. I mean, you can think about it like that. It measures the true performance of your investment portfolio. There's also a thing called time-weighted returns. Now, what is time-weighted return? It is the performance of an investment over a certain period of time, ignoring cash flows. So what do I mean by that? Why does it ignore cash flows? So let's say that you are a money manager and you are managing a mutual fund, and you don't have any control over when people are going to invest in your mutual fund. So you have to buy stocks when you get that money, or you have to sell stocks when they want their money back. So they generated this return, this time-weighted return, so that it really didn't penalize the manager for those move in, move out of money. However, from our portfolio, we kind of want to know that. But if we're comparing our portfolios to the S&P 500 or to mutual funds or to ETFs, then we need to know what the time-weighted return is, because that's what they're going to be giving us. They're going to be giving us a time-weighted return. We need to be able to calculate a time-weighted return ourselves. So it measures, performance of investing decisions, excluding the timing of investments. So often used to compare, and I talked about this already. So let's now look at this example. I think this will really come clear. It's as simple as I could make it, and it may not be exactly right, but it is directionally correct. So January 1st, here's the example. January 1 of any year, you bought 1,000 shares of XYZ company for $10. So you put $10,000 into that investment. Oh, and guess what? In July 1, you bought another 1,000 shares, but now the price has gone up to $20. So you put 10,000 in here, 20,000 in here, you got 30,000 invested in this company. Then at the end of the year, and I did this because I want it to be exactly a year, you sold all 2,000 shares, but the stock price had come back down to $12.50. So, what would be the time weighted return and what would be the money weighted return? Well, obviously, you've got 2,000 shares of the company, and on average, you paid $15 per share. So, your money weighted return is going to be a loss of 16.7%. However, your time weighted return is a positive 25%. Why is that? Because you had this investment for the whole year. It went from $10 to $12.50. That's a 25% return. It does not count when you add money or take money out. So that's the difference between time weighted return, money weighted return. There is a big difference, or there can be a big difference if you make, a lot of movements in your portfolio. But it's important to know that money weighted is really about the portfolio overall. Time weighted would be something you would compare with an index or something along those lines. Okay, so how can we use it? Oh, I'm sorry. How do I use it? How does the Wealth Circuit portfolio measure? And for me, I want to balance time and with the value that I receive. So I don't want to spend a lot of time like doing a lot of measuring, a lot of calculating and that kind of thing. That's just not my role in life right now. I'm retired and I want to kind of enjoy things. I want to spend some time on it, but I don't want to like spend all day doing stuff like that. So what do? I have Morningstar. You can see here in this, this little red circle that Morningstar actually calculates. I have my portfolio in there, and then I compare it with three things. I compare it with the S&P 500 through the ETF VOO, and then I compare it to DGRO, which is a dividend growth ETF, and then I compare it to SCHD, which everybody knows is like the most popular dividends ETF out there. So I try to compare those on a 1 week, 1 month, 3 month, year to date, and a 1 year basis. And so you can see here, I'll just look at and I do this weekly. I don't do this daily. So this will be done on a weekly basis. But you can see for the week, I actually came in third place out of these. The S&P 500 was the most. I'm sorry, DGRO was the most. S&P 500 was second. This portfolio was third, and the SCHD was fourth. When I look at it on a 1 year basis, the S&P 500 comes in first place. We come in second place, and then DGRO is third, and SCHD is fourth. So I don't really make a lot of decisions based on this, but I want to know whether I'm actually keeping up with what's going on out in the marketplace. So here's another thing that I do, and this is kind of, I think, worth the price of admission today. I also calculate my portfolio return. And I do this in Excel, and I basically every week will put in what the balances are. And then I will then look at, so for the week of 126, you can see that this is 126 and this is 126. The actual portfolio return was not 0.84, it was 1.04. Why is that? Because, I made some transactions in there. And then when I look at it on a year-to-date basis, it is instead of 1.03, which is what the time-weighted return would tell us, it was actually 1.34 because of investing decisions. So just wanted to pass that little bit on. So what are the takeaways? Takeaways are measuring performance requires an understanding of our objectives. If you don't know what the purpose of your portfolio is, then you're not going to have an objective. You're not going to know what to compare it to. So you want to figure that out. And then the second thing is the basis for measuring performance must be consistent. It's either got to be time weighted, money weighted, or whatever method you choose, but it needs to be consistent between what you're measuring and your portfolio. Third is measuring performance at meaningful intervals. So it can be week, month, quarter, however you want to do it. If you say, hey, I only want to know 4 times a year what my portfolio is doing, that's great. Just do it on a quarterly basis. Maybe you want to do it annually. I'm good with that too. balance the measurement with time it takes to calculate the return. So whatever you have to do to get those numbers, just balance it. Make sure you're getting what you want out of it. And the next is make course corrections if necessary. And I think that's it. So hopefully that was helpful. I know that some of this stuff can get pretty dry, but as dividend growth investors, sometimes we just need to dig in, and we need to understand our portfolios and even how to measure them and that kind of thing. Because once we do that, then we always have it, and then we make better decisions moving forward by having just a little bit more data, a little bit more information, a little better understanding of what we're trying to do as dividend growth investors. So let's flip the where's my cursor? There it is. Let's flip the script here. I'm going to remove this, and I'm going to put some comments on here. Let's see who all's in the live stream today. My buddy Billy's having some trouble with Discord. So I don't know if you guys have any advice for him. It says he's not doesn't have he has an invalid address. So I'm not really sure what that is. So if anybody's got some thoughts on that, let's give Billy some help here. We have NK or Gnome in the house today. Welcome, Gnome. We got Miguel Fernandez. I'm glad you're here today too, my friend. I always enjoy it when you guys are able to hang out with me. We got Greg in the house. Welcome, Greg. We got Aldo. And Kevin Mendoza. We got two Kevins now in the house, and I happen to be one of those. We got Slammer 6789. Welcome, my friend. We got Phil B. It's down 4% after hours. Yes, sir, that is right. Probably soft guidance is bringing it down. You are exactly right. We got Lucas Orr, and he was talking about Whirlpool in case you joined us a little late. Lucas Orr, it's good to see you as well, my friend, even though I can't really see you, but I can see your typing, so that's great. All right, Kevin wants to just jump right in, so let's go. He says, Kevin, do you like BDCs? The answer is yes. So what is a BDC? A BDC is a business development company. It's some people can confuse them with banks. They're not really banks. They do loan money, and they're more venture capitalist type of thing where they will loan money, but they will also come into companies and help with their strategy, help with their leadership, help with their management, and actually grow those businesses and make them. And they, instead of just getting interest on the loan, they will also get some equity in the company. So as the company grows, their equity grows. And so I think that's a good model. I do like that. My favorite one is Main Street Capital Corp. It has gone up a lot. So and I had just a little bit, and I did sell that off because I want to wait for the price hopefully to come back down, and I can pick up a bigger stake in Main Street Capital. Another one is ARCC, Ares Capital. I know a lot of people like that. I've never owned them, but I do like Main Street Capital a lot. So we got Kamarai is in the house. Chris, it is good to see you, my friend. And Share Delusion, probably just stock-based comp, and maybe that's not really sure. Maybe you're talking about Whirlpool. I'm not really sure. So Steve C is in the house. He wants to know what is the Simply Safe dividends number for Whirlpool. So I'm going to go ahead and pull that up, and then I'm going to switch you guys over to it because I just want that anticipation to be there. Actually, I'm trying to figure out how to stop this. Whoops, I don't want that anymore. So I'm going to remove that. I'm going to stop sharing, and then I'm going to share a different window and show you the Whirlpool Simply Safe dividend number is 60. They did reduce that. I think it was 70 before. Yeah, it was 70. And then on October 30th of last year, they reduced it down to 60. So Whirlpool's struggling. There's no doubt about that. I don't think they're in trouble with their dividend at this point, but they do show that it is borderline, and I think that's a good spot for them to be for Simply Safe Dividends. So we got John J in the house. I'm gonna stop. I'm gonna do that. There we go. So we got John J. Welcome, my friend. Good to have you today. Hey, thanks, man. I appreciate that. When you guys, even when you guys give me feedback of any kind, whether it's, you could do this better, or whether it's like, hey, this is really hitting the mark, it's really helpful for me. And I know other people who do live streams, because we are here by ourselves, right? We're looking into a camera, and all we know is what we see you guys type or what we hear after the broadcast. So, getting feedback like that is really helpful. Really helps us know that you are engaged in the process. Yep, there were 17. I think there's 16 now. So maybe we're dropping like flies. So thoughts on Bristol Myers, and I think that's Valero. So Bristol Myers is undervalued, and I've looked at it several times. It's undervalued. I'm just not clear enough on their drug pipeline to know whether they're undervalued for a reason. They've been undervalued for a long time. I mean, years. So it might be helpful. Let me pull up something that might be helpful. I'm going to pull up fast graphs and show that to you guys for Bristol Myers. Go ahead and add that back in. This is a different thing. So let's look at BMY. So Bristol Myers Squibb. Look at this. I mean, look at how it's been undervalued since at least 2017, maybe 2018. It's been a while, and it keeps trying to make a comeback, but it just can't. And I haven't spent enough time with it to know why that is, but I gotta believe it's to do with their drug pipeline. It's the only thing I can think of that would cause them to be undervalued for that long. So that's my thoughts on that. Let's take a look at Valero while we're here. VLO is a energy company, Valero Energy, and they had a spike. Of course, everybody knows that energy is cyclical. You can see that even back here in the 2000s, and then the teens, and then again in the 18-19 time frame. Now look at 22, 23, and it's just it's very cyclical. I mean, if you bought now, I don't think that would be a terrible time, but I really think we're going to see some better times for all the energy companies. I used to own Chevron, and did I own another one? I used to own Chevron. I still own EOG, and I own Hess Midstream as well, but that's a different animal. I got rid of my Chevron shares because I just have a feeling that energy is going to come down, and then we're going to have some better times ahead in terms of adding those back to the portfolio. So those are my thoughts, my friend, on Bristol Myers and Valero. Jim, welcome to the program, Jim. He says he compares his portfolio to let me get this off the screen. There we go. He compares his portfolio to the S&P 500 over a 3-year period. It would be depressing to compare the S&P on a year-to-date or shorter periods of time. It is kind of depressing, Jim. You get that right. But I do compare mine to the S&P 500 because not because I want to match the S&P 500, because I know that my goals and objectives are different than what the S&P 500 can provide for me. I'm looking for some additional income. So the last time I looked anyway, the yield for the S&P 500 was about 1.3, 1.4, maybe 1.5 now %. And that's just not going to be enough for my portfolio. So I like better to compare to either DGRO or SCHD. DGRO has a lower yield and higher growth rate, SCHD has a higher yield and a lower growth rate. But so my portfolio is going to be in the middle of those two. And if I'm kind of in line with those, I feel like I'm doing pretty good. And if I wanted to, if I didn't enjoy this, I know that I could put money in, the S&P 500, the DGRO, and SCHD in some way, and just kind of leave it and not even look at it for a while. So, but I enjoy this way too much, man. I just can't get enough. Can't get enough. Kevin Mendoza. Um, I don't own any BDCs, but I'm thinking about buying one. Well, that's good. I would wait. Well, I can't tell you what to do. I mean, it's your portfolio. I've chosen to wait and try to enter at a better time. Um, I mean, interest rates are going to be coming down, so I may be totally wrong here. It might be the best time in the world to enter into these BDCs, but I'm thinking that as interest rates come down, some of this money that's in these higher yielding areas is probably going to move into the higher growth areas. So that's kind of where my head's at. It may happen, it may not happen, but you heard it here first. So if it works, I'm a genius, and if not, then I don't know what I'm talking about. So, and it's probably somewhere in the middle. So Kenji, you have to pick winners like Kevin. Hey, I appreciate that, my friend. Sometimes I feel like I'm a winner, and sometimes I feel like I'm a loser when I pick shares like Whirlpool. But hey, and when I'm drinking coffee, all is right with the world. So that's good. Thank you, my friend. I appreciate that. So let's see. Jim's responding to Kevin. He owns Maine. Yep, Maine is a good one, Jim. I really enjoy Maine Street Capital. Let's see. What else do we have here? This looks like something interesting. Kevin Mendoza, Maine is trading at fair value per Morningstar and seeking alpha 2 buys and 1 hold. FYI, maybe Kevin B has some thoughts on it. I like Main Street Capital. One other thing we could look at if you guys are interested is we can go take a look at TipRanks. I've been really happy with TipRanks. Now, as you know, I have a lot of apps, and I think I'm going to do a series of videos on the apps that I have. Maybe one video per app. It'll be really short, but how do we use them? What's in them? Why are they important? I'm thinking that might be good because I use a lot of apps every day. I don't know why I started talking about that, but anyway. Oh, and just FYI, one of the things that's really cool is that we broke the $1.4 million barrier this today, actually near the end of the day. So, we got, we had a 0.67% return on the day, which is about 9,500. We ended the day 1,405,766. Super stoked about that. Another thing I'll point out before, I'm sorry, I'm kind of taking your time here, Jim, but another thing I'll point out is that ADM and Archer Daniels Midland went up about 5.5% today. So that was a good move, at least so far, for the portfolio. Now, what was I trying to do? Oh, yeah, I wanted to look at Main Street Capital. So let's look at Maine. And we are going to look at, they actually have, 3 holds and 1 buy. So that's the same. Oh, so Seeking Alpha has 2 holds and 1 buy. TipRanks has 3 holds and 1 buy. It's pretty much the same. They're saying that there is a bit of a downside, though. As you can see here, they've got analysts that say, hopefully you guys can see this. I think you can. They got analysts that are as low as 43, some that are 48, but they all average out to be around 45.25. So, that's kind of what I'm thinking is that 45 is a good fair value for them. Let's see what Morningstar says about them. I'm going to look up MAIN, Main Street Capital, and we're going to look at. Oh yeah, so it's got a Q rating, and what that means is that they don't have an analyst, a real live analyst that's actually tracking it. They're using quantitative measures to calculate the fair value. So I think it's probably fairly valued today. If you bought some, it wouldn't be a bad thing. But I'm looking to try and get those prices lower. And I could be wrong, and I could miss the boat here, but that's where my head's at. So hopefully that's helpful, Jim and Kevin. But I do like Main Street Capital. If I buy any BDCs, it is Main Street Capital. So BDCs are best in a retirement account because the dividends are taxed as regular income if you buy them at all. That is absolutely correct, Steve. You are correct. If you buy a BDC and you get the dividend from that, if it's not in your tax deferred accounts, and this is for the folks in the US, then those dividends are taxed at your normal income tax rate versus the non-qualified or versus the qualified dividend rate. So that's a great point, Steve. Let's see, OBDC, yeah, that's pretty decent as well. ARCC or a couple others to look into. Yeah, I think that's Ares Capital, ARCC. All right, we got Slammer. He says this discussion begs the question. Oh, this is awesome. I can't wait to have a question that is begging something. If my portfolio is consistently underperforming the benchmark, what do I do? Buy all SCHD and go fishing? That is a good question, my friend, because that is obviously an option, right? I wouldn't do it in the short term though. I would look more long term, and I'm not going to pull mine back up again. But when I look at like a year out, and sometimes you want to go 3 years out, just to say what does it look like over a longer period of time. Investing is kind of a weird thing. For instance, I bought Archer Daniels Midland this week. Well, from a time weighted return perspective, it looked kind of bad because or at least if I'd bought it last week, then it would look really bad because the stock price went way down, right? But if I had added more, let's say I bought one share of Archer Daniels Midland before the drop of 20% or whatever it was. If I bought one share and then I bought 1,000 shares when it went down, it would still only show it would still show that it was going down, regardless of the fact that I made 5% today on 1,000 shares. So it's hard to compare everything uh, that precisely. But at the end of the day, I mean, I want to know that I'm doing a good job. And if I'm doing a good job, I'm going to at least be comparing myself to these guys who are running these ETFs like SCHD and like DGRO. But I tell you what, I mean, if you're young, I don't know, and you're not interested, of course, if you weren't interested, you wouldn't be on this call. But if call it a call. What is that? It's really a live stream. But if you're young and you're not interested, I don't know why you don't just go in the S&P 500, some ETF or a mutual fund or in some way. But folks like me, we just kind of enjoy this stuff. So yeah, it's kind of a hobby, but it's an important hobby, right? I could really mess myself up here, but I do enjoy it, and just because the performance is bad for a time doesn't mean that things are going to be bad all the time, right? You want to give yourself a long enough window because it might actually turn around on you, and then all of a sudden you are outperforming them. So I would give at least 3 years before I made any kind of decision like that. So, but that is a great question, Slammer. It is, why am I doing all this if I can just buy SCHD or DGRO or VOO and just be done with it? And if that's what would make you happy, then that's not a bad idea, right? But for me, I couldn't be happy because I would be sitting around all day wondering what I could be doing in the stock market. I mean, it's just something that I love. So hey, Kevin, do you look at relative strength index RSI when researching stocks? I don't. And I don't know exactly what relative strength index is. I know it in college football, but let's see. I think that when we go back to tip ranks here, I see. I don't know. I don't see a relative strength index. So maybe that might be something proprietary to some service, either a brokerage firm or one of these apps. So maybe you can give me a little bit more on where that comes from. I'm not familiar, and I can't say that I know everything, but I've been around, and relative strength index would be relative to something, and so I'm not really sure what they would consider that relative to. So help me out with that. Fast Eddie, hello, would be here long. Oh, you won't be here long, probably. So I appreciate you stopping by, my friend, and I appreciate you joining because you're important to me, man. Um, Hola from Kevin at Disney Universal. So hola, my friend, que pasa, amigo? So yeah, wouldn't be here long. So glad we clarified that. So let's move on then to Lucas. Lucas, what why do you mostly look for in the conference calls and quite new to listening in on them? Oh, okay. So what do I mostly look for? Oh, and the conference calls for the company. So, for instance, Whirlpool's going to have an earnings call tomorrow. They call it a conference call, and they're going to share what their perspective is. A lot of it's going to be from these slides, but they may add some other stuff that they've actually prepared to share with investors. So, what I look for is maybe I should just actually write this down, but it is really it really depends on what is going on with the company. So, like with Whirlpool, I wanted to know what their results were for the quarter because that tells me that they are either beginning to turn the ship around or they're not. And then I wanted to see where they're going in the future. I wanted to see their cash flow because I know they're paying this dividend. So it really depends on what's going on with the company. With GGG, I'm not concerned about any of that, but I am looking for some growth in their future, and that's why I was a little disappointed I didn't see a 2024 guidance slide other than in the area of sales. But maybe they'll share that on the call tomorrow. So it really depends. I mean, I really go through and try to analyze what's going on with the company, and there are certain things that are going to trigger me. And they'll probably be different for every company. So, and then sometimes they'll throw something out there and go, "Man, I didn't think about that. I'm glad you brought that up." But that's kind of the way I look at it. Here, let's do that. There we go. Okay, NK, Gnome, thoughts on residential REITs like MAA, AVB? Um, I think residential REITs are fine. I mean, take a look at the resident, especially if it's here in the U.S. These residential REITs, the property values are going up like crazy. So these residential REITs, they may be cash poor, but they will definitely have some assets on their books, and so I think those are fine. The ones I would stay away from, if I were to give advice to someone that said, "Are there REITs that you would stay away from?" The answer to that is yes, and they are called mortgage REITs or M REITs, and those are the ones that buy up mortgages. I'm just not really wild about that business model. They're basically, you know, taking up debt and also they're taking on the risk of non-payment as well. And so I just don't think that's a good model. It's not a model that fits for me. So I avoid M REITs at all cost. But I think residential REITs are fine. I know a lot of people are really skittish about office REITs at this point because of the pandemic and the way it's kind of changing the way companies work. In terms of being in the office or not. There's certain office REITs that I like. Kilroy Realty is one that at least when it was down in the low 30s, I liked it a lot. Now that it's in the low 40s, I like holding it, but I don't really like buying it. So those are my thoughts on REITs. Hopefully that's helpful. Um, So, Kevin, thank you. I'll read more about BDCs. Absolutely, my friend. Glad to share anything that I know. I'm just happy to share because that's the good thing about this group. It's a good thing about having a community of people who are kind of working through this together. Because none of us know it all. None of us are the smartest person in the room. And so when we hear something and when somebody asks a question, then we get smarter. We all get smarter by having those questions and by kind of tossing around potential answers for that question. So we all get smarter. That's where this whole idea of collaboration and being a part of a community. That's where this all comes together for me. Is that where I want this to go is I want this to be a place where we can ask questions. We don't have to be worried about what people think about our knowledge level. It doesn't matter. If there's a question, let's ask it. Let's try to get an answer to it. I may not know the answer, but somebody on here will. So that's um, that's kind of where my head's at. I'm not sure how I got off on that. But anyway, I think I was answering Kevin's question about reading more about BDCs. But anyway, somehow I got down that path. So we got Mike in Milltown, New Jersey. C, is that Citigroup? Buy more, sell, hold, maybe. I don't follow Citigroup. I own what bank do I own? Let me think for a second. I'll tell you what, let me just look. It's U USB, US Bank Corp. I own US Bank Corp. That's the only bank that I own. But let's take a look. Let's see what's going on with C. Whoops, that didn't work. C, Citigroup. So it looks like Citigroup is about $54. Maybe this is not a valuation. This is just where analysts are thinking that it's going to go. May have about an 11 and a half, 11, almost 12% upside. So that's not too bad. Let's see what. I'm doing this without even showing you guys. You should yell at me when I do that. There we go. I'm going to go ahead and, Mike, take your comment off of there. So we're still on Whirlpool, but we're about to switch this over to C. So in tip ranks, it showed that there is about a 12% upside, the analysts believe, in the next 12 months. And that's only as good as it actually happening, right? So it's just their opinion. We do have a borderline safe 55, and I don't know. There's a lot of banks that let's take a look at U.S. Bank. There's a lot of banks that they have as a lower. Yeah, it's 55 as well. I wouldn't be overly concerned about that for Citigroup or U.S. Bank. I think there is some concern about regulation and about these bank failures that were last year and things like that. So they've got them as borderline. I'm not too concerned about that. And watch tomorrow, there'll be a big issue, but so they have they're not growing their dividend that much. It looks like they have 1 year of dividend growth streak. So that, as a dividend growth investor, that doesn't excite me a lot. I wish I could do these where I could actually lay one side by side to the other, but let's pull up US Bancorp and see how theirs looks. See, the US Bancorp dividend is just growing. They've got a 13-year dividend growth streak. So I just like them. They've got a 5-year CAGR of 8%. So, going back to C, what is theirs? Their 5-year CAGR is 6%. So, I just like US Bancorp. One other thing for us to check would be, what is the valuation? Looks like they are at about a 20% discount. So, I mean, you can't go wrong there. That gives you a lot of margin of safety, as my buddy Warren Buffett would say. We're not buddies, by the way. See what US Bancorp is. It's about 17%. So, from my perspective, C kind of gives you a, let me get this out of there so that we can. There we go. C gives you, some nice valuation. It's, you're buying it at a lower price. They haven't done well, in my opinion, in growing their dividend. So that's why I kind of lean more toward U.S. Bancorp. So hopefully that's helpful. I don't know. You didn't really ask me that. You asked me whether I would buy more, sell, or hold. I think if it were me, I would toss it and go to U.S. Bancorp. But I'm not buying U.S. Bancorp right now either, even though it is undervalued. So I think the market is pretty high right now, and I'm not buying a lot. There are certain things that I'm buying, and but it's not going to be in the banking area. So we got Kenji here who says he picked up some Amazon, some Applied Materials. I think that's who AMAT is, and AMD. It is micro devices. I forget the first word. Advanced, I think. But thinking about Starbucks, I think it will outperform soon at earnings and pays a dividend maybe tomorrow. So that's not a bad idea. I know that my buddy Ryan Williams loves him some Starbucks. I think this coffee is actually Starbucks coffee. It's their Christmas blend, and it reminds me to take a drink. But so yeah, Starbucks is. I, I like Starbucks. I think they've got some growth prospects in China. And I think maybe they've got some, in the US, but I think it's really more overseas. And so with the geopolitical tension, I think that's really a lot of why their stock is down. I know a lot of people like to talk about this potential union thing. I don't see that as a huge deal for Starbucks. I know that they're also looking at some ways to improve the customer experience through automation. I don't know if it would be AI or just automation, but where the customer experience would be more consistent. So if you ask for a certain kind of drink, then that drink would be made for you, and it would be made the same way every time. So yeah, I like Starbucks. I don't own any Starbucks, but I think that's not a bad idea. Gnome says, does Whirlpool have a moat? Strong goodwill? I personally think no. So many companies make fridges. Yeah. And I think Whirlpool actually owns most of the companies that make fridges. So, yeah, I don't think they have a moat. Let's see what Morningstar says about them. If they do, it would be a narrow moat. They don't actually cover them. Let's see. Yeah, they give them a narrow moat rating, and they do own a lot of companies. I forget what all their brands are. Let's just kind of look at that because that is important. I think when you see the number of brands that are owned by Whirlpool, it is not just the Whirlpool brand. So as investors, we're investing in. Here we go. You ready for this? I'm going to highlight these on the screen. You have Whirlpool, Maytag, KitchenAid, JennAir, and then some of the rest of these I've never heard of, but they're probably like overseas. But Speed Queen, which was wow, that's been a long time ago. So anyway, there's a lot of brands that are in this umbrella of Whirlpool. As a matter of fact, I just bought a KitchenAid double oven. It was really expensive, but it was, it wasn't working. Our old one wasn't working right, and they didn't make it anymore, and they couldn't take the board out and repair it because nobody would touch it. So it basically just had to get tossed, and I bought a new double oven. But you got to keep mama happy, if you know what I mean. So we got the double oven. So do they have a moat? Yeah, I think they do. It is a narrow moat, um, and it's really related to their brands. Oh, I can't believe this. Anyway, here's here's what I failed to put on the screen for you guys. So I read them to you, but I really was hoping that I would show them to you. Oh, here's one that I didn't mention. It's InSinkErator. They bought InSinkErator last year. So if you don't know what InSinkErator is, it is that thing in your sink that a disposal. It's a garbage disposal is what we have always called them. But the brand that they bought is InSinkErator, and evidently it has been a good accretive acquisition for them. So there's a lot of brands just to point that out. Um, Now Goodwill, I don't know. I didn't look for that. I'm assuming since they have so many brands, they do have quite a bit of Goodwill. But rather than take the time to look that up, we'll just assume that they have quite a bit. Okay, Sergio, thoughts on companies like Lockheed Martin that depend on government spending? So, yeah, I got a couple of thoughts on that. One is, Sergio, that I think with all the geopolitical tension, with the wars that are going on throughout the world, I think now is there's not a better time for Lockheed Martin to be overvalued than there is right now. Um, so I have Lockheed Martin used to be, and it wasn't because I bought it that way. It actually ended up becoming one of the largest holdings in my portfolio because where I bought it was in the $330 range, and it ends up in the $450 range or whatever. So it actually became a large holding in my portfolio. I sold some of that off, made it more of a normal weight in my portfolio because things just, in my opinion, aren't going to get better than right now for Lockheed Martin. I think we're beginning to see some of that kind of wane, and because they have dropped here recently. So those are my thoughts on that. I think the government spending is good, but they've got such a long backlog that just the getting an additional spend doesn't really help this current coming year. It does help the future. It does provide more stability for the future, but it doesn't really change the it doesn't move the needle today. So those are my thoughts, Sergio. X to the what? X to the who? X Dividend Dad is in the house. Welcome, X Dividend Dad. It is good to have you on the broadcast. You're probably driving home from work now. So that is fantastic, my friend. It's not a party without X. That is right. Did the 1.4 million stick around with the Whirlpool drop? 1.4 million. Oh, yes, it did. Actually, let's see. Well, 5% of Whirlpool is, I don't know, but yeah, the Whirlpool drop's not going to cause the portfolio to drop below the 1.4. So I am super stoked about that, my friend. So we got Chris, and Chris, just so you know, I did end up buying some more Pinnacle West today. So I appreciate you sharing that info from that news article. So RSI basically tells you if a stock is overbought or oversold. Oh, I got it. Yeah, and I don't really call it that, but yeah, I look at that from time to time. But mainly what I look for, because I am really more of a long-term holder, I don't really look at the this those kinds of things. I mean, I bet it would be helpful if I did, just in terms of timing. So if I'm going to buy a stock today, knowing whether today or tomorrow might be a better time is helpful. But since I hold things mostly for the long term, I don't really pay a lot of attention to that. So, Slammer, don't worry. I'm enjoying my time learning here. I am still working, and I'm trying to find a balance between spending my non working hours digging into stocks with other activities. Yeah, buddy, we all kind of struggle with that. One of the good things is my wife's not here right now, so I'm here by myself. So it is really kind of cool to not worry about whether I'm bothering her or whatever. But we got to kind of work all this stuff around life, and so let me know if you come up with anything cool there that you could share with us. All right. So we've got, let's see, man, we are an hour and 4 minutes already. I hate to get off of this with you guys. I really enjoy being on here. But so we'll take a few more after I have some coffee. All right. Yeah. So, Chris, let's see, technical analysis. Yeah, absolutely. I don't really do a lot with technical analysis. Thoughts on the apps? Good, good. I'm glad to hear that. and include your affiliate links. Yeah, any affiliate links I have are in the comments to these videos. And so if you guys like them and you want to go get, a lot of times, or sometimes there are discounts that come with that as well. Like TipRanks is like 50% off. So if you like that, that link is in the comments. Seeking Alpha, I don't think has much of a discount right now. If anything, they tend to run more programs. But anyway, that link is also down there if you want it. Let's see here, Jim. Talking about banks, any thoughts on New York City NYCB? I think it's New York City Bank. Ex dividend soon, JPM if you have time. Let's take a look. I've left this up the whole time, so that's awesome. Let's take a look at NYCB, New York Community Bank. Yeah, it's a 41 versus the 55. And I think it's just because it's probably a very more local, less regional. So US Bancorp, by the way, is not one of the big banks, but it is the largest regional bank. So FYI for anybody that cares. So we have a 41, and let's see what their dividend. Their dividend streak is not very good. They have 0% growth in the last 5 years. And so, it may be a great stock, it may be a great bank, but they are, let's see what their valuation is, NYCB, if they're covered. Says it's at a 35% discount. So well, this is based on those quantitative rates, but I think if you go down this road, Jim, I think you're going to be buying it for the potential upside in the stock, not necessarily for the dividend growth. So hopefully that's helpful. And we'll pick up JPM on the next one. I've got a few. Wow, I've got quite a few here. I'm going to try to kind of work through some of these. Citigroup's restructuring, I'd avoid them for a while. That's a great thought. Warren Buffett is my neighbor just down the street, about 55 miles. Hey, Jim, drive down and just tell him I said hello, would you? Ex-dividend dad, at your age, drinking that big of a coffee in the afternoon, that's asking for sleep problems. No, I know you're kidding, but it is something that I think about at my age. But when you get to be my age, you don't sleep a lot anyway. So I usually am up. I was up this morning about 4 o'clock. So my wife thinks I'm nuts, but it's, you just don't sleep as much. So nobody's happy if mama's not happy. You nailed that, my friend. Oh yeah, no problem, John. I appreciate I'm glad to do that. Mama ain't happy. Pop's eating G. Whatever that. I'm not even sure what that means. So it's probably something really bad. I don't know. Is Vu set it and forget it? LOL. I really think it is, John. I think the S&P 500 is the benchmark to benchmark against. And if you have nothing else and you don't care about this stuff at all, and you're younger, I would go S&P 500 and not even, I would, party every weekend. Let's see. Can you talk a bit about shared illusion on next program and effects of it on shareholders? Maybe, I think you mean share dilution. Share delusion. I was trying to think of what we would be alluding to or illuminating. But anyway, so yeah, share dilution. Yeah, that's a great concept. I will talk about that. You got it, my friend. Share dilution. That will be the next topic for next week's show. Here, let's get rid of this. Boom. All right, there we go. Okay, just a few more here, and then we'll have to knock it off. We're going crazy here. So, Christopher Dukes, good to have you on, my friend. I haven't seen you on the show today. Bought more Pepsi, GEHC, AEE. I'm not sure what that is. Last week, all during dips. Today, they shot back up. Buying dips is taking advantage of Mr. Market. Absolutely, man. Congratulations. It's always good to get a win when you buy the dip. Yeah, here we go, John. Share dilution. I got it, buddy. It took me a minute, but I got there. Um, so Sergio says, thanks for everything you're doing for the community. My friend, I am enjoying this. I really enjoy spending time with you guys. And but we are now at almost a minute or an hour and 10 minutes. So I'm going to go ahead and sign off today. I look forward to next week. You already know what the subject is. And if you want to get involved in this community, join the Discord. That is also in the link to this video. You can get in there. That's free of charge. You just join the Discord and go in there, and there's some channels set up. If you've never been in that before, it's really more like a chat room where we can just talk about stuff, and then we can just kind of have this 24/7 conversation going on. I love it in there. I think it's really cool to kind of stay connected on a more frequent basis than weekly. So if you are interested in being a part of that community, click on the link below. And if anybody has any thoughts for my friend Billy, let me know. And otherwise, we're going to try to get him in there. We are going to try to get him in there. We will not give up until we do that. So anyway, if you want to become a member of the community, there's a Buy Me a Coffee app, that link that's also there. You can, follow that, see everything according to what's in there. So with that, guys, I'm going to get off of here. I really appreciate you, and I enjoy our times together. I'll see you next Monday.